In this video, I'm going to talk about what a stock is. I'm also going to talk about what ETFs are, as well as index funds. As you guys know, based on the past videos I've made, investing in stocks can be a big part of your investment portfolio. And for most people, they're going to have some sort of knowledge to some degree because stocks are obviously make up your retirement accounts. And a lot of people don't really pick their own funds. They just go up there with the company wants to put it in, or whatever their financial advisor wants to put it in. But me personally, I like to know where my money is going, and I like to pick my own funds because it's my money, so I feel like if anyone screws it up, I'd like it to be me. A lot of my friends or people who want to get started investing kind of ask me questions like, what is a stock? What stocks are good for me to buy? How do I buy a stock? Which are all good questions, and there's nothing wrong with them, but I think you should understand these concepts before you start investing into the market. Now, personally, growing up, I was always under the impression that stocks were bad. I don't really know why this was the case, looking back. It might have been because I grew up during 2008, so maybe that just stuck in my mind and it was just gave me that impression that stocks are bad, you're going to lose all your money, it's basically gambling, you're better off playing blackjack. Now, before we get into index funds and ETFs, we're going to just talk about what a stock is. So if you log on to your brokerage account and you buy a piece of Apple stock, this piece is called a share. And if you buy a share of Apple, you have equity or a stake in that company, and you have rights to the profits and assets that that company receives. Now, the more shares of a company you buy, the more control you're going to have over that company, and you're going to be able to kind of indirectly control the direction that company goes in a way, because the more you buy, as I just said, the more power you're going to have, and you're going to be able to vote in shareholder meetings. Now, the amount of the company that you own is going to be correlated to the number of shares you buy related to the outstanding shares. Now, shares outstanding are the number of shares that are owned by shareholders. So, for example, say Apple stock has 100 shares to administer to all its investors, and you buy 10 shares of Apple stock, you own 10% of Apple. Now, granted, Apple has a lot more shares than 100 they're dishing out, but you get the general idea. The reason companies sell stocks is to raise money to operate their business, and the reason people buy stocks is to have their money make them money. It's essentially they invest in that stock so that money will come back with a higher return. So for example, if you buy 2 shares of Apple stock at $200, so a total of $400, and that price per share goes from $200 to $300, you own 2 shares of Apple stock, so you just made $200. Now keep in mind, this isn't going to happen overnight. Apple stock might not jump $100 from May 1st to May 2nd unless you own Tesla stock and you just get ridiculously lucky. So you want to have more of a long-term outlook on this. And the stock might also just not continuously go up from 2 to 300. It might go from 200 down to 150. So this is why it's really important to understand the business model of the company you're investing in and have a long-term outlook on the company. Now keep in mind, in order to receive the profits on that stock, you have to physically log into your brokerage and click sell. So for example, if Apple stock goes from $200 to $300 and you don't click sell, but then Apple stock goes from $300 down to $250, you don't receive the full $100 per share profit that you would have gotten if you did not click sell. But even if it does do that, we'll say Apple stock goes from 200 to 300 down to 250, as long as the long-term outlook still looks good, the business model is still good, there's no real scandals, there's nothing going on with the company, people tend to hold because it just looks like more of a future outlook. You want to look at the future, you don't want to look tomorrow or next week, you want to look, where's this company going to be in 5 years? And then people might start to sell out once they think, alright, 3 to 5 years this company might not be where it is today, this might be the peak. So you kind of want to have more of a business mindset when you're investing in stocks and have a long-term outlook, as I said before. Now let's move into ETFs and index funds. These two are relatively similar, but at the same time there are a couple of differences that you should be aware of. First, let's talk about index funds. An index fund is basically a mutual fund that's created to track that specific index, such as the S&P 500. Sometimes in index funds, they're not just going to be as simple as buying a single share. There might be a buy-in requirement. I know for some index funds for Vanguard, you have to invest $3,000 worth or so. So if you see one for, say, $200, you might not just be able to buy that one share for $200. You might have to buy $3,000 worth. Now let's talk a little bit about ETFs. An ETF is an exchange-traded fund, which again involves a collection of stocks. A lot of these stocks track a certain index as well, again, such as the S&P 500. But there are other ones out there, and each one might have a little different strategy or a different industry they're working with. It kind of depends all on the one you pick. But again, the basic idea is it's just a collection of stocks. In some ways, an ETF might be more convenient than an index fund because you can't buy index funds during market hours. You have to either put the order in before the market opens or after, which is Monday through Friday, 9:30 to 4. That's when the market's open. But an ETF you can buy during market hours, and it trades just like an individual stock. It's just a collection of stocks. Both of these funds are viewed as a passive investing strategy, and that's why I like them, because you can just invest them, put your money in them, and basically forget about it because you're betting on America. And I don't know about you guys, but personally, based on all that America's been through, all these recessions, I would be willing to bet on America. So that might have been a little bit confusing, but let's see if I can explain it a little bit better with this analogy. So say you're going after pizza, and you have to pick the type of pizza you want: cheese, pepperoni, mushroom, etc. And you really don't want one specific type of pizza, you kind of want a bunch of different slices. So say you pick 8 different slices. You pick cheese, you pick pepperoni, barbecue chicken, buffalo chicken, etc., etc. And you get all of those in one piece of pizza. Well, it's kind of the same thing with index funds and ETFs. Instead of picking, say, Amazon stock, you can just buy one of these indexes or ETFs that track a certain fund, and you'll get Amazon stock along with Apple stock, along with Berkshire Hathaway, etc., etc. To go a little more in depth here, let's look at VU, because that's one of the ETFs I personally invest in pretty regularly on myself. VU is just the Vanguard S&P 500 ETF, and again, it's just like a basket of stocks. Looking at the different sectors that VU is made up of: basic materials, 2.08%, consumer psych, 9.65%, financial services, 13.7%, real estate, 3.01%, consumer defensive, 8.17%, healthcare, 15.62%, utilities, 3.59%, communication services, 10.79%, energy, 2.66%, industrials, 8.36%, and technology, 22.29%. Again, those are the sectors or the industries that VU is made up out of. Now, let's look at the stocks that VU is made up of. We're going to go over the top 10 stocks that VU is made up of, and these are the slices of pizza that go into the entire pizza. Microsoft makes up 5.58% of VU, Apple makes up 4.93%, Amazon 3.77%, Google C 1.62%, Berkshire Hathaway, my man Warren B, 1.62%, Google A 1.61%, J&J 1.6%, Visa 1.28%, and Procter & Gamble with 1.27%. So after going over those different stocks that VU is made up of, look at it this way. You can buy, say, 1 share of Microsoft, and you will own 1 share of Microsoft. But you can also buy 1 share of VU, and you're going to own Microsoft and Apple and Amazon and all those other stocks I just named. As I said earlier in the video, indexes and ETFs are good for retirement accounts because they give you a lot more diversification than you'll see in just a regular stock. In saying that, that is going to be the end of this video. I hope you guys learned something about what a stock is, what an ETF is, and what an index fund is. I'll see you guys in the next video, which is going to be how to buy a stock. We're going to go over different platforms and different brokerages that you can use to buy a stock. And I'll see you guys in that one. Bye-bye.